Gold crossed $4,600 an ounce this week. Silver pushed back above $70. Both moves happened in the same handful of days, and neither one was caused by a war, a crisis, or a surprise from the Federal Reserve. It was caused by a single announcement from the US Treasury Department, a technical, almost boring-sounding decision about how the government buys back its own debt. Most people scrolled right past that headline. I want to show you exactly what it means, why it moved two entirely different metals markets at once, and what it actually tells you about the mechanics running underneath the US financial system right now. And there's a specific number buried in the story, how much of America's own debt foreign governments are quietly stepping away from, that explains why this isn't a one-week story. I'll show you that chart in a few minutes. Video is for informational and educational purposes only. I'm not a financial advisor, and this isn't personalized investment advice. Precious metals and government debt mechanics are genuinely complex, and prices can move against any thesis for a long time. Everything here is accurate as of when this was recorded. Please do your own research and talk to a licensed advisor before making decisions with your money. Now let's get into it. Section 1. What actually happened this week? Let's start with the plain facts in order. On Tuesday, August 18th, U.S. gross national debt crossed $40 trillion for the first time in history, a milestone that arrived roughly 2 fiscal years earlier than the Congressional Budget Office had projected back in 2023. The very next day, the Treasury Department announced it would at least double the size of its long-term bond buyback operations, from around $2 billion per operation up to at least $4 billion, specifically targeting the 10 to 20-year and 20 to 30-year portions of the bond market, the parts of the curve where buyers had effectively been on strike since late June. The market's reaction was immediate. Gold climbed over $4,600, its highest level since mid-May, extending a weekly gain of roughly 5%. Silver jumped more than 5% in the same stretch, clearing $70 for the first time in about 2 months. Both moves happened inside the same handful of trading days, driven by the same underlying cause. So the real question isn't why did gold and silver go up, it's why does a government bond buyback move precious metals at all? That's what I want to actually walk through, because it's a genuinely useful piece of financial plumbing to understand, and it explains far more than just this week's headline. Section 2. What a bond buyback actually is. Here's the plain English version, because the term itself sounds more complicated than the mechanism actually is. The U.S. government funds itself by selling bonds, essentially IOUs, to investors around the world. When there's strong demand for those bonds, the government can borrow cheaply. When demand weakens, the government has to offer higher interest rates to attract buyers, which pushes yields up. A buyback is when the Treasury goes into the market and purchases some of its own previously issued long-term bonds back from investors, using newly issued short-term debt to fund the purchase. The practical effect is that it adds a large, guaranteed buyer into a part of the bond market that had been struggling to attract sufficient demand on its own, which helps hold long-term yields down even while the overall debt load keeps climbing. Treasury Secretary Scott Bessent acknowledged the $40 trillion figure directly, calling it a big number, while arguing the administration intends to grow the economy faster than the debt, and indicated further buyback expansion could follow if needed. Several economists, including Mohammed El-Arian, have pointed out that the market's reaction suggests investors are pricing in the expectation of more intervention to come, not just the direct arithmetic of this specific announcement. That's an important distinction. Markets aren't just reacting to what happened. They're reacting to what they think happens next. Before we move any further into today's topic, I want to recommend something that I genuinely believe can be valuable, especially if you're serious about understanding precious metals, whether you're a complete beginner or an experienced investor. The book is called The Precious Metals Trap. I highly recommend giving it a read because it goes beyond simply telling you what gold or silver is worth. It helps you understand the psychology, risks, common mistakes, and hidden traps that can influence precious metals investors. And honestly, the more you understand the market before making decisions, the better positioned you are to recognize opportunities and avoid costly mistakes. So if you're serious about improving your understanding of gold and silver, check out The Precious Metals Trap and consider picking up a copy. Link in both the description and the pinned comment, so make sure to check it out. With that said, let's get back to today's topic. Section 3. Why this specifically moves gold and silver. Now here's the mechanism that connects a bond market technicality to the price of a metal that has nothing to do with government debt on the surface. When the Treasury steps in to buy back long-term bonds, it pushes those bond prices up and their yields down. The 30-year Treasury yield fell from a multi-decade high near 5.26% following the announcement. At the same time, a government visibly intervening in its own bond market to manage borrowing costs tends to weaken confidence in the currency itself, and the dollar index moved lower in the days following the announcement. Gold and silver pay no yield at all, no interest, no dividend. When Treasury yields are high, holding a non-yielding asset instead of a bond carries a real opportunity cost. You're giving up income you could otherwise earn safely. But when yields fall and the dollar weakens at the same time, that opportunity cost shrinks and the currency you'd be pricing the metal in is worth less, both of which make gold and silver relatively more attractive, almost mechanically. That's the whole transmission chain. A technical bond market intervention pushes yields and the dollar down, and metals move up in response, often within days rather than weeks. Now here's the part of this story that explains why the Treasury felt it needed to do this in the first place, and it's a trend that's been building for over a year. Section 4. Why the Treasury needed to step in at all. A buyback isn't something a government does when things are going smoothly. It's a response to a specific problem. Normal buyers weren't showing up in sufficient volume for the longest dated portion of U.S. debt. Part of that story involves who's historically bought U.S. government debt and how that's shifted. Foreign official holdings of U.S. Treasury securities, the amount held by other countries' central banks and reserve managers, have been trending lower over the past couple of years, a continuation of a broader de-dollarization trend that's been documented by multiple sources tracking central bank reserve allocation, including a multi-year run of elevated central bank gold buying, roughly 1,000 tons annually across recent years, as some official institutions diversify away from concentrated dollar-denominated reserves. When the largest, most reliable category of buyer for long-term government debt pulls back, at the same time the government needs to borrow more than ever, someone has to fill that gap to keep yields from spiking. In this case, that someone became the Treasury itself, stepping in as a buyer of its own debt. That's not a sign of routine, healthy bond market functioning. It's a sign that the normal mechanism needed active support to keep working the way policymakers wanted it to. Section 5. Where gold and silver actually stand right now. Let's put this week's move in context because the starting point matters for how to read it. Gold's all-time high was $5,602.22, set on January 28th of this year. At around $4,600, gold remains meaningfully below that peak even after this week's rally. This is a recovery move within an ongoing correction, not a fresh record. Silver's story is more dramatic. Its all-time high was $121.67, also set in late January, and it corrected by nearly half over the following months before this week's move brought it back above $70, a level that's acted as a genuine technical ceiling multiple times already this year. Worth noting, silver has been outperforming gold specifically. The gold-to-silver ratio, how many ounces of silver it takes to equal 1 ounce of gold, spent much of 2024 and 2025 stretched out above 80-1. It's compressed into the mid-60s recently. A falling ratio during a rally like this one is typically read as a sign that genuine investment demand is flowing into silver specifically, not just riding gold's coattails. Section 6. The honest risk both ways. I want to be direct about how uncertain the next stretch actually is, because a single week's rally isn't proof of a permanent trend. If the Treasury's buyback program doesn't get extended further, or if incoming inflation data forces a more hawkish tone from the Federal Reserve, the same mechanism that pushed yields and the dollar down this week can reverse just as quickly, and both gold and silver have shown this year they're capable of giving back a meaningful chunk of a rally in a short window. Silver's nearly 50% correction from its January high is proof of exactly that kind of reversal. On the other hand, if foreign demand for U.S. debt keeps softening and the Treasury has to lean further into buybacks and similar interventions to manage borrowing costs, that's the kind of structural pressure that tends to support gold and silver over a longer stretch, not just for a single week. Treasury Secretary Besson's own comment that further buyback expansion is possible suggests this isn't necessarily a one-time event. Both paths are genuinely live right now. This week's move is a real, traceable reaction to a specific policy decision. But 1 week of buying isn't the same thing as a confirmed structural shift, and it's worth treating it with that distinction in mind. Section 7. What to actually watch. A few concrete things worth tracking instead of just the daily price. First, whether the Treasury follows through on Besson's comment about expanding buybacks further, since that's an ongoing, evolving story independent of any single week. Second, whether foreign official holdings of U.S. Treasuries stabilize or keep declining. That trend is a slower moving but arguably more important signal than any single bond announcement. Third, where the gold to silver ratio keeps compressing, which would suggest sustained investment demand rather than a short-term reaction. And fourth, upcoming Fed commentary, since a hawkish turn could work directly against the yield and dollar dynamics that drove this week's move. None of this tells you what happens tomorrow, but it tells you what's actually worth paying attention to instead of reacting to the headline the moment it crosses your feed. So here's where that leaves us. Gold at $4,600 and silver above $70 this week aren't the result of a crisis or a surprise Fed decision. They're a fairly direct, traceable reaction to a $40 trillion debt milestone and a Treasury Department stepping in to buy back its own long-term bonds, because normal demand wasn't sufficient on its own. That mechanism, lower yields, a weaker dollar, a government visibly managing its own borrowing costs, is exactly the kind of environment that tends to support metals that pay no yield and carry no counterparty risk. Whether it continues depends on whether this was a one-time intervention or the start of something the Treasury leans into further, and that's genuinely still an open question. If this helped you understand what actually moved these markets this week, instead of just seeing the headline, subscribe so you catch what happens next. And let me know below, did you already know what a Treasury buyback was before this week? This isn't financial advice. Do your own research, and I'll see you in the next one.